What is up guys, Taiki here. Today I'll be simplifying what impermanent loss is, and I'll also go over what yield farms I'm currently watching in the Polygon ecosystem. If you like the content, please like and subscribe and leave a comment in the comment section below. So let's get started. Okay, so the reason I want to make this video is because all the farms I'm watching are farms where you have to be a liquidity provider, right? Being an LP. That includes DFYN, which I'm currently in. I'll go over it in the latter half of the video. QuickSwap, SushiSwap, and the upcoming farms 0x and Kyber, right? All of these farms means you have to provide liquidity because they're all like some form of an exchange. So for me, it seems like, I'm looking for safer farms right now. And those farms, those opportunities are being an LP for the liquidity mining programs where you provide liquidity and you get paid the tokens, protocol tokens to do so. So that being said, let's just go over what it means to be an LP and how these AMMs and decentralized exchanges work and how, I guess, because of those designs, how impermanent loss works, right? I'll go over a couple of examples. So let's just go over Uniswap, right, which is an AMM, and let's say you want to swap USDC for ETH. So let's say you have $10,000 of USDC and you want to buy 3.5 ETH with it. On the back end, how this works is that, each liquidity pair, right, for USDC and ETH, for example. I like to think of these pools as fish bowls, where there's a 50-50 ratio of these two assets. So if you want to buy USDC with ETH, or if you want to buy ETH with USDC, you essentially throw USDC into the pool and pull out ETH on the other side. And this is only possible because there's a lot of liquidity already in this pool, right? There are people all around the world providing liquidity. Right now, roughly $400 million of liquidity. But why are they doing this? Like, they're not just doing this out of the kindness of their hearts. These people are providing liquidity because these liquidity providers earn a 0.3% fee on all trades proportional to their share of the pool. So let's say for this example, let's just simplify that the TVL in this pool, right, the total value locked, is 400 million. Let's say I am a rich fella who decides to put $4 million of liquidity, right? So 4 million out of 400, that's 1% of the pool. So in the past 24 hours, this liquidity pool generated roughly $1 million in fees. And I'm entitled to 1% of the fees because I own 1% of the pool. So that means I would make $10,000, right? So, as a liquidity provider, you get to earn the fees generated by the liquidity pool. So, it's not all great because there are downsides to being a liquidity provider, and that downside is called impermanent loss. I'll first go over the literal definition of impermanent loss, and then I'll follow it up with an example because the literal definition is kind of confusing, where it's the opportunity cost of LPing two assets instead of just holding the two assets, right? So it's how much you underperform compared to just holding the assets. A quick example, let's just go back to this USDC ETH pool, and let's assume that ETH is trading at $1,000 and USDC is trading at $1. And let's say I provide liquidity, so 1 ETH and 1,000 USDC, right? Because it has to be a 50-50 ratio of these two assets. So let's just simplify things and assume that after I provide liquidity, there's 10 ETH and 10,000 USDC, meaning I own 10% of the pool, right? Following me here? Okay, so let's say ETH moons, right? ETH 4x's goes to $4,000. Then what happens? Well, you see that now 10 ETH is now worth a lot more than 10,000 USDC. And remember, there has to be a 50-50 ratio of these two assets. So if ETH just appreciates in value, the protocol, or not the protocol, but the liquidity pool will sell ETH and buy more USDC so it can reach an equilibrium, right? So what it's going to end up doing is, there's going to be more USDC into the pool and less ETH. And at the end, there's now 5 ETH and 20,000 USDC in the liquidity pool. So $20,000 worth of both assets. So let's say now I want to withdraw my liquidity, right? Remember that I owned 10% of the liquidity pool. So when I pull out, I only get 0.5 ETH and 2,000 USDC, right? So this is like what impermanent loss is. Where if I just held the two assets and didn't do anything, I would have $5,000. But because I provide liquidity and the price of ETH went up, now I can only withdraw $4,000. Yes, you are earning fees as you do this, and if it makes up for, this $1,000 delta, then it's all worth it, right? But this is the risk you take when you provide liquidity for two assets that don't move together in price. And this is like a quick chart of like how much impermanent loss you would incur depending on how much one asset moves relative to the other. So Pairing two different assets will always have some impermanent loss. You just hope that the liquidity mining rewards and the fees will make up for it. But if you pair the two same assets, right, so let's say USDC and USDT tether, then there's no impermanent loss because dollar and dollar, right? It moves the same, or it just like doesn't move in general. So yeah, if you're exposed to impermanent loss, IL, you hope that the fees and rewards will make up for it. So right now, this is the liquidity pool for QuickSwap, USDC, USDT. Right now, it's earning 9% in fees, or 9% in fees and rewards. If you combine it, then you can earn 9% on dollars, right? And there's no impermanent loss there. But on the AAVE ETH pool, you see the rewards are higher just because, I guess, it's higher risk because there's impermanent loss, so less people are willing to put it in here. But, 33% is still pretty good. And you can argue that, if I'm bullish AAVE and ETH, and let's say AAVE goes up in price, right, then the pool will sell AAVE to buy more ETH. But if you're bullish both, then maybe you don't really care, right? So if you're bullish, like two assets, pretty bullish on two assets, and you provide liquidity, you can earn the fees and maybe even outperform HODL, depending on how those two assets move. And a lot of people bring up Adamant Finance, which is, I guess, an auto compounder. And it makes sense, right? Instead of 33%, if I take these liquidity pool tokens and put it in Adamant, you get 190% APY. And how these, I guess, the yield compounders work is that if you look at the red square area, it'll essentially sell, in the case of the AAVE ETH pool on QuickSwap, it'll sell the quick tokens that you receive as rewards, and it'll just redeposit it into the AAVE ETH pool. So this is good for someone that wants to accumulate more AAVE and ETH and don't really care about the price of Quick, right? They don't really care. They don't really want Quick. They just want to reinvest it to grow their stack more. Okay, so yeah, this is the 40 Quick a day, which gets distributed proportionally to all liquidity providers. It'll just get reinvested. And the reason I'm not a huge fan of Adamant is just because the rug doctor says it's high risk. I mean, if you do your own research and you think it's safe, then, you do you, right? You do your own research. I don't give financial advice. But, I don't feel like I need to take on this additional smart contract risk. Because yes, 189% is much higher than 33%. But what Adamant is essentially doing is auto compounding automatically, right? But I can do that myself as well. Obviously, having a computer do it automatically will obviously give me better rewards. But it's not really worth the additional risk just because I'll just do it myself. I'm okay if I underperform a little because, hey, I just don't want to take on smart contract risk. I'm a little bit more conservative right now just because the markets are kind of bearish. And the reason of my conservatism is, I went over this many times, but when projects start rugging, this is a tweet by Rookhog, who I interviewed on my channel a few weeks ago. It's essentially the equivalent of market selling tokens without regard for price. This is quite bearish and characteristic of a subtle shift from bull to bear mentality. Well, what does this actually mean? Well, if the markets are bearish, then that means that there's less money in the crypto ecosystem, right? And most of these developers that make these apps, they're not in DeFi to change the world, right? Some people are, obviously, but let's say 90% of them, they're just here to make money or just have fun. So if they realize that, hey, we might be in a bear market and this app that I made isn't making that much money, well, maybe I'll just leave, right? When the developers just leave the project and the token goes to zero, then that's called a soft rug. A hard rug is when the developers literally take all the money locked into protocol. So the example of a soft rug, I went over this in my channel, was Polygon, where at one point they had $200 million in TVL, but at some point TV, all the liquidity left and they just left, right? And what I noticed, I think earlier today, was a shared stake, who was a ETH2 staking protocol, and apparently there's some resolution here, but earlier today a developer just literally hard rugged and took roughly $30 million worth of ETH. So it's just a sign of developers not really having, or I guess when the developers don't really see a future for the project, they just either leave or they just take your money and run because they're anonymous, they can get away with it. So shared stake, I read that there might be a resolution, right? They might have returned the funds, but it's definitely scary if you're like locking your money into these apps, and these developers can take it, right? So that's why I always recommend you check out the rug doctor. So you don't get hard rugged, right? Soft rug, it happens, right? You can't really control if the developer leaves, but you should always try to prevent hard rugs. So that being said, that's why I'm not really interested in taking additional risk given the bearish environment. I can just compound it myself. I don't need to use Adamant. But if you do your own research and you think the rug doctor is wrong and you think it's safe, then you should totally go for it. So that being said, let's transition to something. Let's just transition to the farm I'm currently in, which is DFYN. All right, so I'm currently farming DFYN tokens. I've talked about DFYN in my previous videos, but they just started a round 3 for the liquidity mining program, and I'll just briefly go over the fundamentals. I'm not like here to shill the project just because I don't know if the token will go up, but I'm literally just farming DFYN tokens with stablecoins. So this is a token that I'm just farming to accumulate. They have a vesting system, so I can't really farm and dump anyways. But I see a potential for the project, so I just want to speculate on the token's future price by just accumulating. But how it works is that it's a decentralized exchange across multiple layer ones. It's a cross-chain liquidity pool, so I can, in the future, maybe if they execute, I can take my ETH on Matic and buy Pancake Swap on BSC or something like that, right? Which I think is pretty cool if they can make it work. And yeah, they have some decent investors. They have a lot. I don't know how bullish this is, but according to my research, I'm not 100% sure, but I don't think they'll rug. So always do your own research. But I'm currently in the DAI USDC pool, generating roughly 100% APR. So this is gonna go on for 29 days, and this is obviously gonna go down. But right now I'm earning 27 a day, which is kind of misleading. But I was participating in round 2 of this last month, and speaking from that experience, the stablecoin pairs they go. Right now it's 100%, but it'll go down. I think last time it plateaued around 20 to 30%, which is still pretty good. But don't assume that these numbers will remain high. And you can see that there's other ones too, like Bitcoin ETH is pretty good. There are more liquidity, stablecoin pairs, ETHUSDC, etc. And you can see that the more volatile pairs, right? People don't want to take on impermanent loss, so this one has high APRs, and Curve ETH, for example. So like I said, this is something I'm farming to accumulate. Yes, the price action is pretty garbage, but and also I can't. Yeah, like I mentioned, let's just go to the top. These farm tokens are vested, so after the 30-day program, I can essentially withdraw 25% of it, or of whatever I farm, but the other 25% is released every 2 months. So I'm just accumulating this as a long-term bag, and I'm just earning it for free, so why not, right? So yeah, my approach to this is similar to Cheetah, where I was farming it in May, roughly 30 to 40 cents. And no one really paid attention, but it had this price rise, and then after the iron finance collapse, it just kind of went down. But I farmed it around 30 cents. I sold around $3, so I made 20% profit in a month with stablecoins, which is pretty good. So maybe this is something. Maybe this action is what I'm looking for. I don't know, but it has some resemblance of fundamentals. And if I can farm it for 100% APR. With stablecoins, then I'm gonna do that. Let me just also go over what I'm doing with AAVE, right? So I'm taking 8,500 of each to provide liquidity on DFYN, which I'm still paying an interest rate to do so, but these rates are still pretty good. I think we were too spoiled last month when we were being paid to borrow. But I have DAI here, Bitcoin, so. Just because my collateral is more stable, I'm being more aggressive with my health factor. And this might seem really aggressive, but I did the math, and you can trust me because I'm Asian. And I don't think I'll be liquidated. Or there's always a chance, but it's a very low probability, because right here the liquidation threshold is 77.62%, meaning that if my collateral reaches, or if the amount borrowed reaches 77.62% of my collateral value, then I will get liquidated, right? and you can like go over to the AAVE docs for what it means. But essentially, what it means is that you take, I have 17K borrowed, and just take that percentage and divide it by it, and then it means that if my collateral reaches $22,000, I may or may not get liquidated, which is like the danger zone, right? But if you think about it, I have 16.5K in DAI and 15K in Bitcoin. And for my collateral to reach 22K, Bitcoin would have to essentially dip like 60%, right? Which I don't really see happening. I mean, never say never, but I mean, if this happens, then everyone will be so wrecked anyways that like if I get liquidated, it's like whatever. So, always I guess like do the math there. Obviously, if your collateral is like ETH, Matic, and Bitcoin and AAVE, then your health factor maybe be above 2. But just because I'm taking stables and the least volatile asset, which is Bitcoin, and borrowing stables against it, just be aggressive with it, right? And I am paying an interest rate, but whatever interest rate I'm paying is being outperformed by just my 100% APR, earning this much a day, right? And you can see like I have this much DFYN in total, so I'm just accumulating this. If this ever like goes up to like $10 or something, then everyone's like uber bullish. I don't care. I'll be dumping it because like I hold no allegiance to the token. I just want to take profits along the way because I'm earning it for free, and I don't want to bag hold this to zero. So this is what I'm doing. I'm also looking into like 0x Kyber, which is coming up in the next week. Arbitrum as well. I'm kind of in the Arbitrum waiting room. I think when Arbitrum comes out, I'm just gonna ape into it. And then Curve, they're gonna update. They're gonna, I guess, increase rewards on July 1st. So I'll also be looking into that. So I guess that I'm just trying to be, I guess, transparent with how I'm thinking. And maybe call me a degen, but I think I'm okay. Thank you guys for watching. Have a nice day and have fun farming out there. Thanks for watching till the end of the video. I just wanted to mention that I'm participating in round 10 of Gitcoin grants, where even the smallest contribution matters due to quadratic funding. You can see that even a $1 contribution will be matched $3 by Gitcoin. So if you like the channel and it's helped you understand DeFi, yield farming, etc., and you want to support me in the channel, I would really appreciate even like the smallest donation, because how quadratic funding works is that the more people donate, the matching just increases, right? So thank you for your consideration, and the links will be in the description below.